So how do you feel about markets? How do you feel about the economy? How do you feel about elections? How do you feel about all the stuff that's going on? If you're uncertain, like a lot of people are, do you think there's a chance, maybe even a big chance, that the stock market is lower 13 months from now than it is right now? It doesn't matter. 12 months, 13 months from now. Do you think that 6 months from now, 12 months from now, 30 months from now, the stock market might be lower than it is today? If you do, I agree with you. But if you want to know how to take advantage of that, give me a second. I'll go through it. Investing in the stock market is interesting. There are a lot of ways to do it. Most people invest in terms of they'll buy individual stocks. With retirement accounts, they'll buy into indexes, things like the S&P 500, the Dow, the NASDAQ, what have you. And most people will, for lack of a better word, settle for that average rate of return over time. And that makes a lot of sense, I think, when you're in your 20s or 30s or 40s and you've got income from your job and health insurance is taken care of, and you're making allocations into, it's just incremental as you're laddering into your retirement account at work. You're getting matches on those contributions. All of that makes sense. But we work with people that they've already done all of that. Now they're making the transition to, all right, I have my nest egg. I know what my expenses are. Now I want to be successful in retirement, which to me means I want to be able to maintain my standard of living adjusted for inflation and taxes moving forward, which means I need to generate the kind of income that I did when I was working, but I need to be able to do that no matter how long I live. So we're always looking for investment options that make the most sense moving forward in that scenario. So I'll give you an example. Right now, we're not particularly optimistic on markets. I could be completely wrong. But we're looking at markets being at all-time highs. We're looking at all the money that the government has spent. We're saying, all right, it's not sustainable. Eventually, this is probably going to get bad. We all know this. Markets don't go up into perpetuity. There's always some kind of a pullback. There's always some kind of a recession eventually. There's always a crash eventually. So without being sort of a doomsday, super pessimistic person, all I can say is I think that what's happening right now is not sustainable. I think that the $7+ trillion that we've spent sort of supporting this economy, which has also supported the markets, is something that will eventually end. And I talk to people week after week that are trying to figure out a way to benefit from markets being down versus up. And so the sort of the standard for most people is they realize that if they have a portfolio that's invested in the market, that when markets are going up, they're doing well. When markets are doing poorly, they're doing poorly. So markets are up, you're up. Markets are down, you're down. Right now, if you feel like we do, in that I think the probability of markets being significantly higher 12 or 13 months from now, I think is pretty low. We've had a really good run. I'm not going to complain against it, but to have an anticipation that the next year, the next 12 or 13 months, will be as good as the past, I think is pipe dream. Pick a phrase, but just not good. I would actually rather bet if I'm investing that markets are down. So I had a conversation here just the other day with some investment professionals that we work with, and the conversation went like this: I think markets are likely to be lower than they are now 13 months from now. What if we built an investment that would benefit our clients if markets are down. So we went through and we ran the numbers. And again, this is not an offer. This was just something that we ran. We wanted to find out what those numbers looked like. But I'll share that with you right now. What it meant was we were going to do a 13-month investment through something called a structured note. And we got the numbers back. And what it said was we could offer our clients, again, we did not, but we could offer our clients a 300% or a 3x return on the downside of the market. So what that means is if between now and 13 months from now, the S&P 500, it was based on the S&P, if the S&P 500 was down 5%, our clients would get paid 15%. Or if the S&P 500, was down 3%, pick a number, so 3 times that is going to be 9%. So it would be 3 times the downside our clients would get paid. And the only way our clients could lose money in this particular scenario would be if the S&P 500 was up more than 20%, 13 months from now. So if you take a look at what I do for a living and who I work with, and we're helping people retire or close to it, find investment options that are attractive, I wouldn't come to somebody and say, hey, listen, you should put all of your money in this investment. But as a allocation to their portfolio, if I said I have an investment that's going to protect you if markets are down, in fact, it's not only going to protect you, you'll get 3 times whatever the S&P 500's downside is in this example. But if the S&P's up, you're not going to make money. I think most people would find that to be an investment option that they might like for a portion of your portfolio. So the purpose of this video is to explain, if somebody isn't sitting down with you and explaining to you what all of your investment options are, and if somebody hasn't told you, oh, by the way, there are options that could benefit you if markets are down, but also protect you if markets are up. If you're not having that kind of a conversation with your advisors, give us a call. Go to guardingyournestegg.com. I'll go out, find what's currently available, explain that to you, and if you're interested, maybe we can make it happen. Thank you for watching. Go to guardingyournestegg.com for your free and objective personal financial plan.